The management of KEC is with us. And let's just sort of bring in the management to talk about the numbers. Fourth quarter was impacted by a 450 odd crore rupee collection spillover. Margins fell about 80 basis points due to operating deleverage, leading to a weaker than expected performance. Vimal Kejriwal is MD and CEO of the company. Mr. Kejriwal, good morning. Great to have you with us here. Thanks very much for joining us. So can you just sort of, before we get into the specifics, fourth quarter, just characterize that for us? Was this West Asia, headwinds, execution challenges? And of course, I mean, if you start by telling us, what's the expectation for FY27 revenue growth?
So let me just talk about Q4 first. I think we had, I'll say, 2 or 3 major challenges. One was obviously West Asia, and with 25% of our order book from West Asia, there has been a challenge, especially on the supply chain side. You know, whether it is steel supply or whether other material supply from China or Europe. So we had talked about it earlier also. So roughly, I'll say around 400 crores and odd, or maybe slightly more or less, has been the revenue impact in March itself. And although it's getting under control, but it's still continuing. So that was one major issue. The second issue, which was in India, was on the labor part of it. We had roughly around 30,000 labor, and they are down to 15,000 now. At the peak, they had gone down to 12. A combination of Holi and all that, but I think the biggest impact was on the elections in Assam and Bengal, where all the labor went back, and they are still not yet back. Few of them have come back. So I think we have got 1,000 people coming back. I think that was one major issue which was there. So these 2 factors sort of combined. And I think the third piece is that Q4 was slightly weak in terms of the India performance also from the transmission. Because if you look at the way the orders were awarded during the whole year, H1, there were quite less order intake in terms of India T&D. And that's why there was a slowdown in H2 a little bit. And secondly, I think with all the discussions on gridlock, what happened was that there was a huge focus on completing existing projects. A lot of resources were diverted towards completion of the existing projects, leaving a little bit less focus on startup of newer projects. I think to me these are the 3 major factors which led to a pretty subdued quarter 4.
Well, just that labor, the numbers, if you can just run us, what is this is for India, right? The labor issue?
This is for India, basically civil. The transmission needs to be added also a little bit, but in the civil, we had roughly around 30,000 people, down to 12 in April, or in fact, starting with March, because March people first went for Holi, then they did not return because of the SIR exercise and the elections. And even today, we are at 15,000 against the requirement of 30. Wow. So if you take an average, I'll say, I don't think that's very representative, but take an average of around 1 lakh rupees per month of revenue out of the labor. 18,000 is straight away 1 into 180 crores.
Yeah. You know? But why is that? Why is this such a big? Is this seasonal in nature?
So it started as seasonal, basically let's say on Holi and all that. Typically people go and then they come back. Holi and Eid combined. But then with the elections and with the entire pressure on, voting and your name getting deleted, etc. So everyone went back. You talk to anyone in Mumbai or talk to anyone in Gurgaon, people don't have houses, people don't have security.
Yeah.
So, yeah.
You expect them to come back gradually, but surely? Or
so
maybe...
out of the 18,000 who have gone Mangalam, at least 3 have come back. The promise was that almost all will come back, but they are coming a little bit slower than what was expected. We still have a challenge even in Q1 little bit. I think they are coming back now. 3,000 have come back, as I said earlier.
Right. So in light of all of this, what can you foresee for this particular financial year? Let's break it down into H1 and H2, because H1 will still be fraught with a lot of the uncertainty that we're seeing. There's still no clarity on West Asia. And obviously with the Prime Minister's comments coming in with regards to, being a lot more responsible with expenditure, etc., do you think that the government, given its current position, will also not up the ante on capex too much, maintain it?
So a couple of things. One is we have an order book of roughly around 37,000 crores and an L1 of 3,000. So I don't see a growth, let's say anything between 10 to 15% growth will definitely be possible for the year. So I think that's for the entire year. Now Q1 will definitely be weaker. I still expect that we may be flat or may have a slight growth. I cannot say today exactly what will happen. But for the year, I think we are very clear that we will at least do 10%, but it could be anything between 10 to 15%, depending how things pan out. That's one thing. Secondly, you talked about government expenditure. So basically, if you look at our order book, we don't have too much of direct exposure to government. There's hardly any major orders from the government or which come from the budget, except for the around 1,000 crores of order book which we have from water. We don't have a direct exposure that way. So I don't think we are directly concerned or would be impacted by government slowing down the capex in any manner.
Right, but not necessarily the government, but the signaling that it does, and as a result of which, it trickles down. But I take your point. You have a fairly comfortable order book, and execution is something that you're fairly confident on, 10 to 15%, give or take a quarter or two. In terms of inflows, what are you targeting this year? And if you could break that up from T&D, from railways, from the civil, which accounts for nearly a third of your overall business right now, and West Asia, where your order book is still 10,000 crore. Do you expect any more orders to come, given the challenges that are right now?
So overall, this year we were around 25,000 and odd crores in order intake. 27, we are expecting around 30,000 crores of orders to come in. Roughly, I don't have the exact break of each business, but roughly T&D is expected to be around 60%. So around, let's give or take 17, 18,000 will come from T&D, and around 7, 8,000 would come from our civil business. And the rest would be divided between, railways, cables, and renewable business. That's a very broad breakup, I'll say, on the order intake. As far as West Asia is concerned, you're right, we have an order book plus L1 of roughly just about 10,000 crores. And today, we have got a large pipeline of tendering, both in all three places. I'll say we are in Saudi. There are continuous tenders coming up. Then there are UAE, again, bids are happening. There's some large interconnections are going to come now, and Oman. So all the three countries, we are seeing a continuous flow of tender pipeline, tenders happening. So I don't think we are factoring in any slowdown in that business today. I think we have to keep in mind a couple of things about West Asia. What we are also seeing is there are going to be, and we already done a couple of, some rehabilitation orders coming in. Then there will be orders for redundancy. We're already hearing that talk of, do they want to build another channel, between Saudi and, let's say, Bahrain. So there will be a lot of these things coming up on the transmission side also. And third is with whatever problems we have seen on fossil, we are clearly seeing a lot more push on the renewable side, which will lead to renewable as well as T&D.
Just two quick numbers before I let you go, Mr. Kejriwal. One is on your tender pipeline. If you could give us, quantify that, what is your West Asia tender pipeline right now? And as a result of which, how much do you expect to win this year? And the second number is on margins. No problem on execution, no problem on orders. But obviously, costs have increased, labor availability is an issue. So all these things would have a negative impact on your margins, given the sort of raw material price inflation that we've seen as well, right? So on your margins for FY27 and the tender pipeline that you have for West Asia, two numbers.
West Asia, I think it's around 25 to 30,000. 30,000 crores is a tender pipeline today. When I say today, it's for the tenders which we have to quote in the next couple of months. I'm not talking about the annual pipeline. That's number one. Margins to me today, honestly, is very difficult to quantify. Very, very honestly, today, difficult to quantify. We are in touch with most of our clients, especially on West Asia, where the costs are going up. India, so we are receiving positive responses. I don't think we have received a confirmation of any one of them as of now, but they are willing to help you on cash flow. They're looking at it. It also depends upon what sort of force majeure clauses you have in your agreement with them. A labor cost in India is going to be a bit of a challenge, because that is typically not passed through except when tenders are linked to WPI. So wherever they are WPI, etc., you'll get a pass-through in cost. But otherwise, there could be some impact of the labor costs on your margins, definitely.
A couple of 100 basis points?
No, not that much. I see, if you look at a typical civil project for me, labor would be around 10 to 12% of my total project cost. Okay.
All right, take that point. Thanks a lot. That's given us enough to think about and ponder on as we move forward as well. Always a pleasure speaking with you. With that,
thank you, Manglam.
Let's welcome Dharmesh Kant, Head of Research, Chola Securities. Dharmesh, you heard the management of KEC International on T&D, on CapEx, and all these companies. What do you foresee as the opportunity from here on in terms of order wins, in terms of margins, the labor availability, and are there any investable ideas which look compelling at this point in time?
India, good morning, Mangalam. Thanks for having me for the show. I mean, whatever I heard was more of a concern on FY27, be it, input cost or the labor cost and execution and the outcomes. So everywhere it was a caution given by the management. I mean, he was not willing to put a number onto the growth guidance, and it was a hopeful growth guidance of 10 to 15%. So it's again a very vague and a wide range of guidance which has been given. So what I expect is was the price correction happens, the valuation comes into a radar of say 25, 27 times 1 year forward PE multiple. From there, a call can be taken. But this year, as you know, the situations prolong and get extended, is likely to be a tough year. And secondly, during the onset of monsoon, most of the labor problem won't be coming back because they stay back for cultivation and sowing. So this problem is likely to continue into Q1. So Q1, avoid all such companies, wait for the price correction and more clarity to emerge before taking a call on these products. And copper prices, Nigel has been repeatedly pointing out, it's still towards the sky high. 51% kind of a price appreciation has happened in copper in CY25 and year till date, both put together.
Got it. Okay, all right. Hi, Dharmesh. Good to hear that you're tracking my commentary on copper as well.